All right, so today let's dive into a real head scratcher.
Yeah.
Like imagine, a dividend yield that's like 6 times higher than the average for the S&P 500.
Wow.
We're talking about medical properties trust,
Okay.
MPW for those of you in the know,
Right.
boasting a hefty 8.4% yield. Potentially, you could earn $1,000 in dividends annually
Really?
with just an $11,900 investment.
Oh, wow.
I mean, that's got to be
Wow.
like a siren song for any income investor, right?
It's definitely tempting, no doubt about it.
Right.
But venturing, into any uncharted territory,
Yeah,
we need to make sure that we're not walking into a trap.
exactly. And that's why we're here today.
Yeah.
We're going to unpack some articles from the Motley Fool,
Okay.
and they raise some serious questions about MPW. They're suggesting that this dividend might be built on shaky ground.
They are indeed.
Okay.
So to understand, why this is such a big deal,
Yeah.
let's start with what makes MPW so alluring in the first place. That eye-popping 8.4% yield.
All right, so break it down for me.
Sure.
Why is MPW's yield so much higher than, say, the average company
Okay.
on the S&P 500?
Well, a dividend yield, you see,
Right.
is calculated by dividing the annual dividend payout per share
Okay.
by the stock's current price.
Okay.
It's essentially the return you get just for holding the stock, separate from any potential price increases.
Got it.
Now, MPW's yield is sky high
Right.
because its stock price has plummeted
Uh-oh.
over 83% in the past 3 years.
Ouch. That's a steep drop.
It is.
So lower price inflates the yield.
Precisely.
Okay.
And while this might seem like a bargain,
Right.
a price drop that dramatic
Yeah.
often points to underlying issues within the company.
See.
And that's where the Motley Fool's skepticism comes in.
Yeah, they really don't sugarcoat it.
No, they don't.
They point out that MPW has already cut its dividend
Yeah,
twice in the past 2 years.
Yeah.
It's currently at 0.28 per quarter,
Right.
a significant drop.
Huge drop.
From the $29 per share
Yeah.
they were paying out in 2023.
It's a substantial reduction
Wow.
and a signal that investors just can't ignore.
Right.
It raises concerns about MPW's ability to maintain its current dividend,
Yeah.
especially given the volatility we're seeing in their financial reports.
Right.
Their net income seems to swing wildly.
Okay, so what's behind these wild swings?
Wow.
Is it just like typical market turbulence or something more specific to MPW's business?
What's interesting here is that this volatility is directly tied to MPW's business model.
Okay.
They are a real estate investment trust,
Right.
or REIT,
Right.
that focuses specifically on healthcare facilities.
Okay.
They lease these properties to hospital operators,
Oh, yeah.
and that's where the alarm bells start ringing.
You're referring to the recent Chapter 11 bankruptcies
Yes.
of 2 of MPW's major tenants,
Right.
Stewart Health and Prospect Medical, right?
Exactly.
What kind of impact does this have on their bottom line?
These bankruptcies
Yeah.
are major red flags for MPW.
Right.
When key tenants can't pay their rent,
Yeah.
MPW's income takes a direct hit,
Makes sense.
making those generous dividend payouts look a lot less secure.
So it's not just about the numbers.
No.
It's about the real-world consequences.
Absolutely.
Imagine depending on those dividends for income,
Right.
and suddenly they're slashed
Yeah.
due to factors completely outside your control.
Exactly. It underscores the need to look beyond the surface
Yeah.
and understand the company's underlying business
Right.
before jumping into any investment,
Of course.
especially one with a yield as high as MPW's.
The Motley Fool seems to be taking this approach,
They do?
recommending that investors steer clear of MPW altogether.
Yeah.
Is this an overreaction, or is it a prudent move in this situation?
I wouldn't call it an overreaction.
Okay.
The Motley Fool is leaning towards caution,
Right.
which is certainly justifiable considering the circumstances.
So help us understand those risks. What are the crucial factors an investor should consider
Okay.
when assessing a high-yield dividend stock like MPW?
Okay.
What are the warning signs?
When evaluating a high-yield dividend stock,
Yeah.
especially in a volatile sector like healthcare,
Uh-huh.
it's crucial to delve into the company's financials
Okay.
and understand its potential vulnerabilities.
Okay.
We've already touched on tenant bankruptcies,
Right.
which can significantly impact a REIT's income
Right.
and its ability to sustain dividend payments.
So it's not enough to be dazzled by the high yield.
No, it's not.
We need to look at the company's financial health.
Exactly. You want to see consistent profitability
Okay.
and a healthy cash flow
Right.
that can easily cover those dividend payouts.
Makes sense.
A history of dividend cuts,
Yeah.
as we've seen with MPW, can be a red flag.
What about their debt levels?
Mm-hmm.
Do those play a role in evaluating dividend safety?
Absolutely. High debt levels
Yeah.
can be a major concern. When a company is burdened with significant debt,
Right.
it reduces its financial flexibility
Hmm.
and makes it more vulnerable to economic downturns
Makes
or unexpected expenses.
Okay.
This can put pressure on their ability to maintain dividend payments.
So essentially, we're looking for a company with solid financials,
Yes.
consistent earnings,
Mm-hmm.
manageable debt,
Right.
and a proven track record of paying dividends.
Precisely. And even then,
Yeah.
it's essential to remember that no dividend is ever guaranteed.
Right.
Companies can face unforeseen challenges that force them to adjust their payouts.
Okay.
That's why diversification is so crucial in any investment strategy.
That's a great point.
Yeah.
But before we delve into diversification,
Okay.
I want to go back to MPW's tenant troubles.
Right.
You mentioned they're a REIT focusing on healthcare facilities.
Yes.
Can you explain how tenant bankruptcies
Sure.
specifically impact their ability to pay those tempting dividends?
Of course, as a REIT. MPW generates revenue
Right.
by leasing its properties
Yeah.
to healthcare operators.
Makes sense.
When a tenant files for bankruptcy,
Right.
they may stop paying rent
Oh.
or even break their lease entirely.
Oh.
This directly impacts MTW's income stream,
Okay.
leaving them with less cash to distribute to shareholders as dividends.
So it's like a domino effect.
Exactly.
Tenant struggles lead to MTW struggles, which ultimately impact the dividend.
Exactly. And because MPW specializes in healthcare properties,
Right.
they're particularly vulnerable to shifts in the healthcare industry.
Makes sense.
Changes in regulations, reimbursement rates,
Right.
or even patient demand
Okay.
can all affect their tenants' financial health,
Right.
which then trickles down to MPW.
So this all boils down to the listener and their potential investment.
Yeah.
Imagine relying on those dividends for income.
Right.
And then, bam, they're slashed
Yeah.
due to factors completely outside your control.
It's a harsh reality. And a reminder that thorough due diligence is essential
Absolutely.
before jumping into any investment,
Yeah.
especially one with a high yield that seems too good to be true.
Right.
Take the time to understand the company's business model,
Okay.
its risks,
Uh-huh.
and its long-term prospects.
Okay. So we've established that MPW might not be the slam dunk investment
Right.
its dividend initially suggests.
Yeah.
But let's broaden the scope a bit.
Okay.
If someone is interested in high yield investments,
Mm-hmm.
but wants to manage risk,
Right.
what are some alternative strategies or asset classes they should consider?
That's a great question.
Okay.
Instead of putting all your eggs in one basket
Right.
with a company like MPW,
Yeah.
diversification is key.
Okay.
Spreading your investments across different asset classes
Right.
can help mitigate risk.
Makes sense.
Don't bet everything on one company
Wow.
or even one industry.
What are some examples of these alternative asset classes that could offer a similar high yield potential,
Right.
but with potentially less risk than MPW?
Well, sticking with REITs for a moment,
Okay.
you could explore REITs in other sectors.
All right, like what?
For example, industrial REITs
Okay.
that own warehouses and logistics centers
Right.
are benefiting from the growth of e-commerce.
Okay.
Or you could look at data center REITs,
Uh-huh.
which are riding the wave of cloud computing.
Those sound like they might be a bit more stable
Yeah.
than relying on hospitals,
Uh-huh.
especially given all the changes happening in healthcare.
That's the idea.
Okay.
Finding sectors
Yeah.
with strong long-term growth potential
Okay.
and less susceptibility to economic shocks.
Makes sense.
Another option could be master limited partnerships
Okay.
or MLPs.
MLPs.
These are typically involved in energy infrastructure,
Right.
like pipelines and storage facilities.
I've heard of them, but I don't know much about them.
Sure.
Are they known for high yields too?
They can be, yes. MLPs often distribute a large portion of their cash flow to investors,
All right.
which can translate into attractive yields.
Okay.
However, like any investment,
Right.
they come with their own set of risks and considerations
Sure.
that require research.
So research is key no matter which direction you go.
Absolutely.
What about venturing outside the stock market altogether?
Okay.
Are there fixed income options
Yeah.
that could provide a decent yield
Uh-huh.
without the same level of volatility as stocks.
Absolutely. Bonds are a classic option.
Right.
Bonds for income-seeking investors.
They're often seen as a more conservative investment than stocks,
Yes.
offering stability without the roller coaster ride.
That's a good way to put it.
Right.
So within bonds, you have various choices.
Okay.
Like corporate bonds
Right.
issued by companies.
Okay.
Or municipal bonds issued by state and local governments.
And then there are those treasury bonds
Uh-huh.
backed by the full faith and credit of the U.S. government.
Yeah.
Those feel about as safe as you can get, wouldn't you say?
They are generally considered to be very low risk.
Okay.
But it's important to note that even with bonds,
Yeah.
yields can fluctuate
Yeah.
based on interest rates and market conditions.
Right.
Diversification is still important.
Okay.
You might consider bond funds
Yeah.
that invest in a variety of bonds,
Right.
spreading the risk.
This is already a lot to consider, but I'm curious about one more thing.
All right.
You mentioned that even with bonds, yields can fluctuate.
Uh-huh.
Can you explain what makes bond yields go up and down?
Of course, bond yields are essentially the return you get
Okay.
from holding a bond.
Right.
It's calculated by dividing the bond's annual interest payment
Yeah.
by its current market price.
Yeah.
Now, bond prices and yields have an inverse relationship, meaning when bond prices go up, yields go down,
Okay.
and vice versa.
So they move in opposite directions.
Yes.
But what causes those price changes in the first place?
Several factors influence bond prices. Right.
And consequently, their yields.
Okay.
One of the most significant factors
Yeah.
is interest rates.
Okay.
When interest rates rise,
Right.
newly issued bonds offer higher yields
Uh-huh.
to attract investors.
Okay.
This makes existing bonds with lower yields less attractive,
Makes sense.
pushing their prices down and yields up.
So it's like a competition for investors' money.
Exactly.
New bonds with higher yields
Right.
can make older bonds look less appealing.
Precisely another factor is inflation.
Okay.
When inflation is high,
Right.
investors demand higher yields to compensate for the erosion of their purchasing power.
Right.
This can also drive bond prices down and yields up.
So inflation isn't just about rising prices at the grocery store.
No.
It also impacts the bond market.
It absolutely does.
Okay.
And then there's economic growth.
Okay.
When the economy is strong and growing,
Right.
investors tend to be more optimistic
Yeah.
and willing to take on more risk.
Okay.
This can lead them to shift away from bonds. Makes sense.
And into stocks,
Right.
putting downward pressure on bond prices
Okay.
and pushing yields up.
So a booming economy
Mm-hmm.
can actually be bad news for bondholders.
Yes, that's right.
In terms of yield. But remember, a strong economy is generally a good thing overall.
Right.
And bonds still play a crucial role
Yeah.
in a diversified portfolio,
Okay.
providing stability and income potential.
This has been incredibly helpful
Good.
in understanding the dynamics of the bond market.
Yeah.
It's fascinating how interconnected everything is in the financial world.
It truly is. And that's why it's so crucial to stay informed
Right.
and understand the forces at play
Right.
before making any investment decisions.
Well, I think we've covered a lot of ground already.
Yeah.
From the allure of those high-yield dividends to the importance of diversification
Right.
and understanding the bond market.
Yeah.
What are some other key points we need to consider
Okay.
when evaluating an investment like MPW? All right. We've talked about diversification and touched on some alternative investments, like REITs and other sectors, MLPs and bonds.
Okay.
But there's another layer to consider
Yeah.
when assessing a company like MPW.
Okay.
Their financial metrics
Right.
beyond just the dividend yield.
Okay. So we're going deeper into the numbers.
We are.
What are some key metrics
Okay.
that can give us a better understanding of MPW's financial health?
One crucial metric
Yeah.
is the payout ratio,
Okay.
which tells us what percentage of a company's earnings is being paid out as dividends
Right.
for REITs.
Okay.
We often look at the funds from operations
Right.
or FFO payout ratio
Okay.
instead of earnings.
Got it.
A high payout ratio suggests the company might be stretching
Mhm.
to maintain its dividend,
Okay.
potentially cutting into funds needed for future growth,
Right.
or even putting the dividend at risk
Yeah.
if earnings decline.
So where does MPW stand
Oh,
in terms
yeah.
of his payout ratio?
That's where things get interesting.
Okay.
MPW's FFO payout ratio
Yeah.
has been hovering above 90%
Wow.
in recent quarters.
Really?
This means they're paying out almost all of their operating cash flow as dividends,
Okay.
leaving very little room for error in comparison.
Right.
Many well-established healthcare REITs
Yeah.
aim for a more sustainable payout ratio, typically in the 70–80% range.
That does raise a red flag.
It does.
A high payout ratio like that suggests their dividend might be vulnerable.
Right.
Especially if they face further challenges, like more tenant bankruptcies
Right.
or a downturn in the healthcare industry.
Exactly. It's a tightrope walk.
Yeah.
And any misstep could lead to a dividend cut.
Right. And remember, MPW has already cut its dividend twice.
Yes, they have.
In the past 2 years.
It's true.
So there's precedent for it.
There is.
This is a great example of why looking beyond the surface is so crucial.
It is.
That tempting 8.4% yield
might be masking some underlying financial strain. It's like being lured in by a flashy sales pitch, but then reading the fine print and discovering hidden fees and conditions.
That's a great analogy.
So going back to those alternative investments we discussed earlier,
Sure.
Could you elaborate on those options?
Okay.
Let's say our listener wants to explore REITs in other sectors.
All right.
What are some specific types they might consider?
Well, as I mentioned, industrial REITs are an interesting area.
Okay.
They own and lease out warehouses
Right.
and distribution centers,
Okay.
which are in high demand
Yeah.
due to the surge in e-commerce.
Right.
Companies like Prologis and Duke Realty
Okay.
are major players in this space.
Okay, those are names I've heard before.
Yes.
What about data center REITs? You mentioned them as another potential growth area.
Data center REITs are definitely worth considering.
Okay.
They own and operate the massive data centers that power the digital world.
Yeah.
From cloud computing to streaming services.
Wow.
Equinix and Digital Realty Trust are two leading companies in this sector.
All right.
And they're seeing strong demand as our reliance on data continues to grow.
That makes sense.
It does.
The more we rely on the internet and cloud services,
Right.
the more those data centers are needed.
Exactly.
It seems like a pretty solid long-term bet.
It does.
What about those MLPs you mentioned?
Sure.
Can you give us a real-world example of how those work?
Let's say you invest in an MLP that owns a network of oil pipelines.
Right.
That MLP generates revenue by transporting oil for energy companies.
Okay.
A portion of that revenue is then distributed to you, the investor, as a cash distribution.
So in a way, it's like owning a tiny piece of that pipeline network and receiving your share of the profits. And those distributions are often taxed differently
They are.
than regular stock dividends, right?
That's correct.
Okay. MLPs are structured as partnerships.
Right.
So their distributions are often taxed as ordinary income
Okay.
rather than qualified dividends,
Right.
which can have tax implications,
Yeah.
depending on your individual situation.
It seems like there's always a trade-off, right?
There is.
Higher potential yield might come with different tax implications.
Exactly. It all comes back to doing your research
Right.
and understanding the specifics of each investment before diving in.
Okay, let's shift gears to bonds.
Right.
You mentioned them as a potentially less volatile alternative to stocks.
Yes.
Can you walk us through the different types of bonds
Sure.
investors might consider?
Of course, as we discussed earlier, bonds are essentially loans you make to a government or a company.
Okay.
In return, they pay you interest over a set period of time and repay the principal when the bond matures.
Right, like an IOU with interest.
Exactly.
Now, when it comes to types, you have government bonds, like U.S. Treasuries, considered among the safest investments.
Yes.
They're backed by the full faith and credit of the U.S. government.
Right.
You also have municipal bonds issued by state and local governments.
Exactly.
These can offer tax advantages,
Right.
as the interest is often exempt from federal income tax and sometimes state and local taxes as well.
That's true.
So if you're looking for a low-risk, stable income stream, government and municipal bonds might be a good option.
It could be.
What about corporate bonds?
Corporate bonds are issued by companies to raise capital.
Okay.
They typically offer higher yields than government bonds,
Right.
but also carry more risk, as the company's financial health can impact its ability to repay its debts.
So with corporate bonds,
Yeah.
you're essentially betting on the success of that particular company.
In a way, yes. That's why it's crucial to research the company's financials,
Right.
its debt levels, and its overall financial health before investing in its bonds.
It seems like no matter what type of investment you're considering,
It's true.
whether it's a high-yield dividend stock,
Right.
a REIT,
Mm-hmm.
an MLP,
Right.
or a bond,
Yeah.
Thorough research is the common thread.
Absolutely. Knowledge is power.
Right.
Especially when it comes to investing.
This conversation has really broadened my perspective on investment options.
Good.
But I know we need to wrap things up soon.
Okay.
Is there anything else we should touch on before we close out this deep dive?
Let's see.
Okay, so we've covered a lot of ground today.
We have.
From dissecting those tempting high-yield dividends
Right.
to exploring alternative investment strategies like REITs, MLPs, and bonds.
I think the key takeaway for you, the listener, is that investing is rarely about finding a one-size-fits-all solution.
Right.
It's about understanding your own financial goals.
Okay.
Risk tolerance. And doing the research to find investments that align with your individual needs.
That's a great point.
Yeah.
This isn't about following the crowd or chasing the highest yield blindly. It's about making informed decisions that fit into your overall financial plan.
And it's also about recognizing that risk and reward often go hand in hand.
Makes sense.
High-yield investments like MPW can be enticing.
Right.
But they also come with a higher level of risk.
So let's bring it back to MPW.
Okay.
Is that 8.4% dividend a siren song? Or could it be a legitimate opportunity for some investors?
It's a question that requires careful consideration if you're an investor with a high risk tolerance who understands the intricacies of the healthcare REIT sector and has the time to closely monitor MPW's performance.
Yeah.
It might be worth considering.
Right.
But for investors seeking a more stable, predictable income stream,
right,
there are likely more suitable alternatives.
That sounds like a diplomatic way of saying,
well,
proceed with caution.
Caution is never a bad thing in the world of investing.
That's true.
What we've aimed to do today is arm you with the knowledge and insights to ask the right questions, do your own due diligence, and make a decision that aligns with your unique circumstances.
I think that's the perfect way to sum it up.
Good.
This deep dive has been about empowering you, the listener.
Absolutely.
Not just giving you a simple yes or no answer.
It's about equipping you with the tools and information to be a more informed investor, capable of navigating the complexities of the market and making choices that support your long-term financial well-being.
So for those intrigued by high-yield opportunities, but also mindful of the risks, where should they go from here?
Keep learning.
Go.
Explore those alternative investment strategies we discussed. Delve deeper into the world of REITs, MLPs, and bonds. Understand their nuances, their potential benefits, and their inherent risks.
Makes sense.
And don't be afraid to seek guidance. From a financial advisor who can help you tailor an investment strategy to your specific goals and risk tolerance.
That's great advice. Knowledge and guidance are essential in this journey.
Absolutely. And remember, investing is a marathon, not a sprint. Focus on building a diversified portfolio that balances risk and reward and stay committed to your long-term goals.
Beautifully said.
Thank you.
Thank you so much for joining me on this deep dive.
It's been my pleasure.
It's been enlightening, to say the least.
Always happy to help demystify the world of investing.
And to all our listeners, thanks for tuning in.
Yeah.
Keep those questions coming, keep learning, and keep diving deep
Absolutely.
into the world of finance. Until next time.
Sounds good.